I'm just a simple kid from Minnesota. Let's do the math. Say if the final number is 4, how are we going to get to 4? Is it 1 plus 3, 2 plus 2, negative 4 plus 8? I still think we're getting to 4. Brian, what are you talking about? I think stocks are higher a year from today. I think stocks are higher at the end of the year. Why? I think, again, and I disagree with Mr. Leisman. If you're not changing the market and your call doesn't mean that you're not watching and assessing what's going on. No, here's how you assess what's going on. With the facts, okay? Now, a recession and structural changes in the market, let alone bottoms, do not happen in one day. Anyone calling a bottom in a day, I think it takes a process. Whoever you were speaking with, Scott, last night at dinner had it flat on, exactly right. That is excellent commentary, and I think that's the right way to think about it. From a fundamental perspective, the reason why yields are going down is the fear trade, number one, but also, two, think about the rest of the world, okay? I stand behind my overall theme of dollar-denominated assets. The rest of the world is coming to America for stability, not only in terms of income in their fixed income, the dollar in terms of currencies, but stocks. So from a longer-term perspective, whether or not it's a week or 12 to 18 months, we're still advising clients to be a high-quality investor on the growth side and a high-quality investor on the dividend side. We stand behind our 3,400.
You tell me why your earnings target isn't too high, and then you tell me if it's not too high, why the market deserves a 19.5 times multiple on your earnings number, because that's how you get to 3,400.
Well, we get to 3,400 in 3 different ways, Scott. We run a dividend discount model, a PE model, and a macro regression model. As you know, macro models have been excessively wrong for 10 years because they're backward-looking and too negative. The PE model has been wrong the last few years because of where people had their risk profiles. In terms of dividend discount models, if you have a lower risk-free rate, which obviously we do, we can afford a higher multiple. And then it goes back to the whole stability trade, Scott. We believe that investors are going to be paying for stability. We don't make short-term calls in terms of downgrading the market. We are investors. We run portfolios for private client investors in both Canada and the United States with a 22% turnover, and we outperform longer term. So again, trying to make short-term calls, I think, is very dangerous, and this is about a process. The process of the correction, by the way,
but you're not making a short-term call. You're making a 9-month, 10-month call. You said stocks are going to be higher at the end of the year than they are today.
I am, and I'm not going to make a call that today's the bottom, nor am I going to make a call that we're heading into recession, because, oh, by the way, I think those are the wrong calls. And so you need some perspective in terms of how this correction and what has transpired the last few days. Thursday was a terrible day. Friday, we had the reversal. Monday, over the weekend, everybody got nervous, got the big up day on Monday where you bought the rumor, sold the news on Tuesday. Now we're trying to figure out where are bonds going and what does that mean for your positions. But again, going back to my earlier math, I still think the number in terms of math is 4. How we get to 4? Are we going to be 1 in the first half and 3 in the second half in terms of earnings? I think that's probably more likely.
So are you saying, first of all, 2 questions.
Then hold on. Steve Weiss is going to ask a question, and then Tony, feel free to. It sounded like you had something you wanted to say to Belski.
Yeah,
Steve Weiss,
I definitely
go first.
So,
not to him directly.
So, Brian, what have you done with your S&P estimate? Because I think consensus was about 174 this year. You're at 176, which is a little higher. So have you adjusted it? And if not, is it because that you foresee it just being a timing difference that we pick up in the second half or whenever this ends? I don't disagree with your target. I think in 3,400 going out a year, I just think it's to be a 21 multiple, not on a 19.
Well, numbers have been coming down from a consensus basis for a while, which is only part of our earnings methodology. I would say that number one. Number two, yeah, I do think that no one's really talking about a demand shock on the upside the second half of the year that could actually drive earnings a lot higher than most people think. I think people are being too defensive. We reserve judgment in terms of potentially changing our earnings forecast, but we're not going to change our market forecast at this time because we just don't see the data fitting that in terms of the efficacy of changing our target at this time in terms of the facts.
Okay.